All right, everybody, here we go. We're on episode number 12 of the Mary podcast. And today we're here with Michael Pierce. He's our more regular fill-in nowadays. Hey, Michael. And of course,
Hey,
Adam Doran.
hi there.
And Adam, of course, is with Prevail Wealth Strategies. And we've talked to Adam before with Boulder Creek Investments, but he's here today with our Mary audience, which is obviously much bigger. He has always provides unique investment options. He has one today that people should really consider, especially in this time of the market volatility. So Adam, thanks for joining us. Go ahead and go into telling the people about yourself and what you have for us today.
Thanks, John. Well, yeah, as you mentioned, Prevail Innovative Wealth Strategies, we seek to be an industry disruptor. We do things differently. And when we're living in a time like we are right now, where people are reminded that market volatility is real, people start looking at strategy and saying, okay, what are maybe some of my other options out there that I might not have considered? And particularly in working with real estate investors, what we find is they're particularly concerned about two primary topics. One is liquidity. So the wealth that they're building, having access, having liquidity to act on opportunities, having access to cash to act on opportunities. And then the second thing being, just being able to mitigate taxes where we can. Mm-hmm. And so at Prevail, a lot of our focus is on helping people plan for and mitigate taxes by building tax-free assets and having opportunities for tax-free income. My personal specialty, because I am a real estate investor myself, so the things that real estate investors are thinking about, I'm thinking about. And it's really important to me that as I go through the time and process of building personal wealth for myself by investing in real estate, what is my capital strategy? What am I doing with cash? What are my options for places to put cash that will allow me to insulate it from things like market volatility, from things like rising future tax rates, but also to have liquidity and be able to access cash when I need it and do deals. And so that's really where I spend my focus and what I specialize in helping real estate investors to do is to be strategic about capital management.
Very good, very good. And to add on to that too, how's the current pandemic, situation affecting, the current investor you have now, or even clients coming in with their questions on looking at something like this?
Yeah, I would say, and this won't be news to anybody, but there's a lot of uncertainty and nobody has a crystal ball. But I will tell you some of the things that are on people's minds right now as I'm meeting with clients is preservation of existing capital. So whatever it is that we have accumulated thus far and whatever assets we have, trying to preserve and protect those things against loss. That's really big on people's mind. Market volatility is really big on people's mind. And then for folks who maybe part of their capital strategy, their cash strategy was that they had exposure to the markets and, nobody really saw this coming until it was already here. And a lot of people sustained significant losses in their market portfolio. And so if that happens, now people are reevaluating, well, maybe instead of a brokerage account, I should be looking at different places to keep cash so that I'm not risking downside loss while I'm holding a cash position. I don't want to lose 30% of my cash position and then not be able to do a deal when there's an opportunity. So we're seeing people being focused on not losing what they've got and then maybe reevaluating capital strategy. I think taxes also are more and more becoming on people's radar because frankly, with all the stimulus spending, at some point we've got to start making up for that. And the obvious answer is, well, tax rates are likely to go up.
Mm-hmm. Mm-hmm. As we know, most like our children's children could be possibly paying for all the stimulus, that we have now. And they will definitely be looking for ability to raise tax revenue because we got to pay for this somehow. So it's going to be definitely interesting times. And the more we could prevent that or hide behind it in some way, obviously legally. And a lot of people use this method, the better.
It was interesting. You brought up about our children's children, future generations having to deal with paying for some of these things we're currently, shelling out cash for, the government shelling out cash. One thing that happened that was, I guess, pre-pandemic, or at least before it came to our shore here in the US, the Secure Act passed pretty quietly without a lot of fanfare. The Secure Act passed back in December. And I think a lot of people are still getting familiar with that. And there's a really key measure in there that maybe a lot of people aren't aware of right now, and it's going to matter. It's going to matter to the people that inherit traditional retirement accounts from their parents or grandparents, people that have preceded them, who pass away and then leave them a qualified retirement account like a 401k or an IRA. So just so everybody who's on here listening knows what has happened here with the Secure Act is the stretch IRA has pretty well been eliminated. It used to be if you had a parent who had $1 million accumulated in an IRA and they passed away, and that asset passed to their child could then take required minimum distributions each year from that account based on the child's expected lifespan. So they could stretch out the withdrawals on that IRA. That went away with the Secure Act. Now the new rule is if a parent dies with that same $1 million in an IRA or 401k, and they pass that to their child, the child will be required to liquidate that, to spend all of that down in a 10-year period. So imagine if an 80-year-old, 80-something parent dies and leaves to their 50-something or 40-something child who's probably in their peak earning years this pot of money that's an extra $1 million, and now they've got to spend it down, at least $100,000 a year. That's $100,000 a year of extra taxable income. And so that's to our point that we're talking about of, the government's already finding ways to raise tax rates creatively, where they haven't outright said, hey, taxes went up. But with the Secure Act, taxes just went up on everybody who's going to inherit those accounts.
Wow.
Dang.
That's a pretty big deal for sure. Funny how some of those things just get passed.
Yeah, it was over Christmas break. And so those are the kinds of things that I know, right? Those are the kinds of things that we monitor at Prevail, and then try to have strategies in place to put people in more control so that, something like that doesn't catch them by surprise, and they're better positioned basically to insulate their assets from taxes.
Makes sense. I took down that sharing just in case like our video wasn't coming through. So now At least now it's coming through for sure. So, it was up for a while. We could put it up later, but I took it out just in case. So everyone could see our good looking faces here. Maybe, do you want to just as a basis go into an overall process of how it works? You could start anywhere you want, but maybe give the viewers this overall strategy.
Sure. Yep. So as far as my specialty around capital strategy for real estate investors, we use an asset class that I feel like is not often discussed in financial planning conversations and definitely is very misunderstood. And the asset class we use is cash value life insurance. And that's because when it's structured properly, it comes with some very unique tax benefits and some very unique financial planning levers that we can pull that you just can't create with other asset classes. And I'll just high level go over a couple of those because depending on where somebody's at in the process of building wealth and in the life cycle, different things matter to different people. But first off, most real estate investors, if you're successful, you end up having this good problem of having extra cash, especially in between deals. And so the question becomes, where do you put that cash to keep it basically as a warehouse, a pool of capital? And, there's only a few options. There's taxable accounts like savings accounts, business checking. You could put it in a money market fund. You could do a brokerage account. Most people don't want to tie their money up in CDs and bonds because then it's not really liquid if you have a good deal come up, a hot deal. Mm-hmm. So, but one of the other options would be cash value life insurance. And the reason that you might be interested in that is because once you get dollars into that account, They're insulated from market volatility. It's totally non-market correlated. You have guaranteed contractual upside in the contract. There's a death benefit attached, which is not our primary motivator, but it's nice to know that's along for the ride. So we're taking care of our family if something happens to us. And there's usually some provisions or riders within that contract where if you would become disabled and you can't earn an income, the asset continues to fund itself. And then there's usually riders or provisions where down the road, long-term care, we all know, can be very expensive. Long-term care insurance is expensive. You can actually begin to tap your death benefit while you're alive to cover long-term care expenses. But then as a capital account, from a liquidity perspective, you have access to money within this cash value life insurance policy. And whether you leave the money sit and just let it bake and let it grow at a very conservative interest rate. I mean, we're talking 3-4% tax-free interest. So it's not necessarily impressive, but it's better than a savings account. But if you cycle through that capital and choose to use it, you never interrupt the compounding growth of the account. So whereas with a savings account, if I have 100 grand and I pull out the 100 grand and go do a deal, I now have zero in the account earning interest. So I've got zero, there's the account's not moving forward. It's waiting for me to deposit the cash back. Granted, you're picking up an asset when you do the deal, but that's all you have is the asset. You've emptied the account. With a policy, you can do that same thing. You can have $100,000 in cash value. Go do your real estate deal with the 100 grand. The policy continues to grow. The dividend continues to grow. You never interrupt the compounding growth of the account. So that at such time you either refinance or you sell the asset and you put the 100 grand back, you now have been credited all the same interest and dividends that you would have earned if you never used the money. And so over the course of a lifetime and building assets and building wealth for yourself, not only are you building a real estate portfolio, you are building a tax-free cash asset, which can also serve as a tax-free stream of income in retirement. So you can basically build multiple assets simultaneously. And that's probably the biggest piece, for a real estate investor that makes a difference as far as why should someone look at this as a capital strategy.
So they pay dividend. It's like a dividend that you get paid out monthly for the.
No, it's paid yearly.
Yearly. Okay.
Yep. And goes towards the growth of the account.
Okay. Does it take like a snapshot of how much money you have? I don't know, like at January, then that's what the payout is.
So the dividend's declared at the beginning of every year.
Okay.
So each policy owner knows what they'll be getting that year as far as dividend is concerned.
Okay. Yeah, I'm trying to think, because like, couldn't you? So you said you'll keep earning interest even if you pull it out.
That's correct. So if you were scheduled to receive a dividend of, let's say, $1,000 in a year, and I don't know what your cash value would be, but let's just say it's $50,000, and you went and you leveraged that with $50,000 and you did a deal. Even if the $50,000 is being leveraged at that time in use in your deal, that year you're still going to receive the full $1,000 dividend, even if you don't get the money returned to the account that year. So you never stop the growth of the account.
Oh, okay. Could you, I don't know if this is like allowed, but could you just take your money out and then put it back in and say, oh, here's a new 50K that I made. I'm returning it to increase my dividend? Because that sounds kind of, yeah.
So the IRS, that's a really good question, Michael. The IRS knows that people structure these kinds of tax advantage assets. And so they do, I guess, cap the amount of gains you could make in any given year.
Okay.
They put a limit on how much extra cash you can put into life insurance as an asset each year. And there's a complex set of rules behind that. But the best way to explain it is there's a ratio based on, your age and your insurability level, whether you're standard, preferred, et cetera, et cetera. And the IRS basically says, okay, for your situation, if you're funding this policy at $1,000 a month, you can't fund it any more beyond that $1,000 a month this year. And if you do, it triggers what's called a MEC, which is a modified endowment contract, which basically the IRS says this is no longer justified as a life insurance policy. You're not purchasing enough death benefit. You're putting in too much cash, and we're going to tax the whole thing. And so one of the things I specialize in, we're now diving into the weeds here, guys, but one of the things I specialize in is helping clients in structuring that asset so that we fit within those guidelines, which is why I shared earlier, you're looking at a net tax-free rate of return on that account of around 3 to 4%, because that's consistent with where the IRS caps you. So you couldn't do it and pull off like a 12%.
Okay, I was just wondering.
Yep.
Like,
Yep.
yeah, throwing it back in now. Okay,
Yep. It's
cool.
strictly a cash platform. And to that point further, I would say, I wouldn't view this as an investment. I don't think that's the way to view it, because first of all, you're not taking any downside risk. Generally with investments, you're taking some risk. And second, it's not going to give you an investment style internal rate of return. I mean, it's just not. It is a cash account. And so, when you're considering your options for cash accounts, we just think it deserves a seat at the table in your discussion of, well, what are my options for a capital account?
No, yeah. We like the weeds sometimes. It just proves you know what you're talking about.
Yeah.
So that's not the worst thing. Yeah, for sure. I mean, definitely when you're compared to market volatility, just getting something really solid like that, and then versus a bank account, having the death benefit on the family side, obviously, that's definitely a large benefit. This is something that I'm pretty sure you mentioned before, that if you had like a bankruptcy, they can't touch an asset like this. Is that right?
So in most states, you have some built-in asset protections where the money's safe from creditors and lawsuits.
Right.
I can speak to Kansas for sure, because I'm a Kansas resident, own some Kansas policies, and that's true in Kansas. But it's a state-by-state thing. So you always want to check with your, whichever attorney you consult for asset protection, what are the rules in your state? But yes, similar to your personal retirement accounts, you're going to have some built-in asset protection there. I think another thing that's worth note is if you have kids and they're likely to go to college, when you fill out the FAFSA, any cash value that's accumulated within a life insurance policy does not count as part of the family's assets or expected family contribution on that FAFSA. So that's a good piece of information to know as well.
Yeah, for sure. Do clients ever get to a point where it like self-funds from the returns? Okay. It's obviously so many years down the line.
Yep. So, and again, kind of diving into the weeds here, but the structuring of these can be flexible based on client's timeline for funding this particular asset, and also for what it is that you're trying to get done. Some people want to use this more as a cash vehicle, like what I'm discussing for real estate investors. Other people just want to do a simple transfer of assets where they have, say $1 million in tax deferred assets, and they're concerned about the tax burdens going into retirement. So over a 10-year period, we might phase that $1 million into a tax-free account like this. And the reason we would do this is because a lot of the clients we work for, they make too much money to qualify to make contributions into a Roth, and or they make too much money that $6,000 or $7,000 a year into a Roth doesn't really move the needle for them, and or they're young enough that they're still well under 59 and a half, and they want to have access to the money. And obviously with a Roth, you got to wait till you're 59 and a half unless you meet a few conditions. So those are all some of the reasons why somebody might do this.
Okay.
That's a good point.
Is this similar to like a HSA account, or does that totally different?
I would say an HSA is an animal all to its own, but also you make a really good point of that's a lot of strong tax advantages to the HSA account as well.
Yeah, obviously. I guess they're both life related in some way.
Yep.
And then for one other question too, as far as distributions, some people, obviously you could use it for real estate investments, taken out for there to do that stuff. You'd be paying the money back to yourself. Do sometimes people take distributions at older ages just to draw it down, and then whatever they have left, obviously if they pass, they just get that subtracted off the amount they have in there?
Yep. So again, if you use this as a source of tax-free retirement income, the way we structure it is such that we're going to take policy loans we'll never pay back. Mm-hmm. And because they're loans, they're not taxable income.
That's
now the insurance company wants their money back, right? And so the way they know they're going to get that is if those loans are taken out and never paid back, they're going to take it off the top of the death benefit. So you basically are able to take tax-free income in your retirement years. And then after you pass, the death benefit will cover whatever your balance is on your loans plus interest. And then there will be a remainder tax-free death benefit to your family. This is a system that wealthy families have been using for years. I mean, this is used by Walt Disney, Ray Kroc, the lady who founded Pampered Chef, Doris Christopher. Joe Biden uses this. Jim Harbaugh uses this. I mean, there's just the Rockefeller family. There's a ton of examples of the wealthy and affluent using this, which probably brings up another good question that hasn't been asked, but some people might say, you know, I've read about this and I heard that it's the rich man's Roth, right? And so I'm not sure if it's for me because I'm not, you know, wealthy and affluent. And I would say it really comes down to tax strategy. And I think to evaluate whether or not this fits in your financial world isn't so much well, I'm not wealthy enough. I think it's more of sitting down with your priorities. How important is liquidity? I think that's a big piece of it. And then how important is it, you know, that you pay less taxes in retirement? Because that's a big piece of it too.
Yeah, no, that's a huge point that I like to point out. You know, after all those years of having, you know, something structured like that where those returns are going to be really stable, to take that out as distributions into, you know, your retirement years tax-free. And then you're still getting a guaranteed death benefit because last I checked, everyone's most likely going to die. So, I mean, I could definitely see that as people being able to pass generations of wealth on, and which is the reason why they probably put that the limit on there. Is it correct?
Yeah, absolutely. And I would say, shoot, lost my train of thought here. So speaking of distributions, because I think this brings up a really good point, and actually you could forget everything we just said, and what I'm about to say is probably the biggest, most expensive piece of the pie in retirement that people don't plan for. I think we significantly underestimate the impact of taxes on retirement income. And to illustrate that for you, I have a 40-year-old female real estate investor client that I modeled this out for year by year. If you use this as a tax-free vehicle, or if you primarily concentrate your retirement savings in tax deferred. And we ran the numbers with her doing the same $600,000 a year into either this strategy or into a tax deferred account. And then beginning from age 71 to age 90, taking distributions that would give her a yearly income of $85,000 a year in retirement. When we did this strategy, which was using the cash value life insurance policy as a tax-free asset, we gave her $85,000 a year in tax-free income from age 71 to 90. And assuming she dies at 90, there's a remainder death benefit of $915,000. So she took $1.6 million in tax-free income and left another $900,000 to her family. That's almost $2.5 million of tax-free money in exchange for the $600,000 she put in over her working years. Mm-hmm. We then compared that to a scenario where she did the same with a tax-deferred account. And what we found is if she retires in the 24% tax bracket, which she may not, but we had to make an assumption, so we assumed 24% tax bracket, right, she would have to withdraw $112,000 a year to realize the same $85,000 in income, and she runs out of money at age 79, so in 8 years. So I think, again, we just really underestimate the impact of taxes on retirement income. And I think planning for that variable is massively important. And I think in traditional financial conversations, that gets neglected. We focus so much on accumulation rate of return, we forget just how much that taxes matter when we distribute.
It's ridiculous. And you guys know how I feel like about taxes. I severely dislike them. Any tax benefit we could get through, you know, write-offs, deductions, strategies like this are huge. I mean, it's a way to make a substantial amount of money / you know, keep your own money without necessarily having put in more work. It's just, you know, just a new strategy to look into. That's why, you know, someone like yourself or your CPA or accountant can be your best friend, because it's just sitting out there. What kind of little tips and tricks can you take advantage in the tax code, or strategies like you're talking about that people have not really known from the past just because of marketing or just how laws change and these are designed. Now you have more access to these that the wealthy have been using forever.
For years, yeah. Yep.
Right.
Sure.
So that's huge. Michael, go ahead and just wrap up with your question, and then we'll get into some final contact info and get along with our Friday here.
Okay, yeah, thanks. So I was just wondering, so like it sounds really good. Like, is there any, I guess like limitations to using this? Because like also, you can't take a withdrawal, I'm assuming, every month if you had a deal every month. So just like, what are those limitations?
Yeah. Well, if I'm not mistaken, Michael, maybe what you're really asking is why wouldn't somebody do this? Is that kind of?
Yeah, that's kind of where I'm at. Yeah, it's
Yep.
yeah.
Yep. So there are definitely a couple reasons somebody may not do this, or it may not be a fit for them. One of it is just like putting your money into any other vehicle, there's a cost for admission. And in this case, we're building an asset on an insurance chassis, and insurance costs money. So there's an expense structure in there. And because of that expense structure, the insurance company knows they're going to have to make good on a death benefit at some point. So they build the expenses into the front years of the policy's life. You're paying for a cost of insurance, basically those first 10 to 15 years of the policy's life. And so with that being the case, in a given year, you put in a certain amount of dollars, those first 10 to 15 years of the policy's life, you're not going to have liquidity of 100% of that. So if you put in 50 grand this year, you may only have access to 25. Okay. And the following year, you put in another 50 grand, you've now put in 100, you might only have access to 60 or 70. And so that would be the downside, or the disadvantage is you're not going to have 100% liquidity until you get past a certain point in the lifetime of the asset. Now, the flip side of that is, as a long-term strategy, you get far enough into this, and just as John said, the dividends are large enough, the asset funds itself, carries itself. You might put in 50,000 in a year and your account balance goes up by 300,000. So over the course of the policy's lifetime, you average that out, and what you end up with is basically a high interest cash account at 3 to 4%. But that's one of the reasons somebody might not do this is, you don't have immediate 100% liquidity. Another reason somebody might not do this is if it's not structured properly. Because if it's not structured properly, you can't achieve any of the stuff that I'm telling you about. And if you go to Insurance Shop ABC and want to talk this strategy, they're going to have a conversation with you focused on death benefit, which is not what you're after. You're after the asset. And if they design a policy that's optimized for death benefit, then you're going to end up paying a whole lot of money for insurance that you're not real interested in having, and you're going to have very, very little cash value accumulation. So that's another reason somebody might not do this is, not having the right asset being structured for them, and basically end up purchasing an expensive insurance policy. Another reason that somebody might not do this is, maybe your income isn't consistent enough, or you haven't accumulated enough assets where you have the ability to fund this at a meaningful level. It shouldn't become a new line item expense in your budget. So if you're not already earmarking dollars towards a financial plan for yourself, if you haven't already accumulated some assets that you could transfer over to fund this, one of those two, if you don't have that capability yet, then it's probably not the right timing and probably not the right solution. And then I would say one last reason somebody might not do this is, it does require insurability because we're building this on an insurance chassis. It may be that you're in your 80s, so insurance is very expensive. Yeah. It may be that you're not in good health, and so maybe you're not even insurable. There are ways to work around that one. The owner of the policy and the insured don't have to be the same person. So we do have some 70, 80 plus clients, 70, 80 plus years old, and their grandchild is the insured. So there's ways around that. But those would be kind of the high points, Michael, on reasons somebody might not do this, or kind of the cons if we're doing a pro-con.
Right.
Yeah.
Okay, yeah. Yeah, thanks.
Well, those are good points. And, everybody understands we're investors. We know that anything that happens overnight is not necessarily is going to be a huge gamble. We understand things take time. We're okay with the long haul of investment stuff. If it takes longer, it takes time to build up. That's something we feel that is most likely worth it. Obviously, keep in mind, Adam, you guys developed a policy to be more cash value beneficial, and then it'll grow with you as you may have more wealth, your family gets bigger, so your protection's going to grow there with you, so you're going to have the death benefit there. I mean, just don't forget about that, because at the end of life, that's going to be a huge portion of this deal.
Yep.
While being able to do the distributions,
Yes.
being able to use it for investments, everything like that. So, I mean, there's kind of benefits along the whole path of the strategy. And obviously keep in mind, even if you did take stuff out to fund, like you mentioned, it's like everything was there from the beginning, even if you did take stuff out. So every strategy that is worth it, obviously takes time. And I think people understand that, and it's not a big deal. If you're promising 100% returns in 30 days, that'd be a tough thing to convince people. So I think people don't mind that it's a steady thing with tax benefits, which is huge. Plus, just having tax benefits, saying it's not tax, I mean, that's awesome in itself. It's not like a small percentage, that could change. It's just saying it's not, and zero is better than a variable rate. So that's huge. As you guys can see, Adam's been with the local Kansas City Investor Group, and actually all around the United States. He's done talks all the time, specifically with investors, high net worth individuals. He's come well referred. I've known Adam for years, no issues. So, I mean, if you guys get into this strategy with him, you won't be disappointed. Adam, go ahead and tell him about that webinars. You do those regularly. You meet with us. So, I mean, you've done this spiel tons. Go ahead and tell them where they can get extra information too.
Sure. Yep. So Prevail Innovative Wealth Strategies has a YouTube channel. I encourage you to just go on YouTube, type in Prevail Innovative Wealth Strategies. And we've got a couple webinars there we've done on tax-free wealth building. I just did one earlier this week on capital strategy for the real estate investor. Those are all up on YouTube. A lot of great free information there so that people can kind of study up and educate themselves, and decide if it's even something worth exploring for themselves. So we're very much taking an educational and a consultative standpoint, and not everything is for everyone. So we understand that too.
Yeah, well, you're good at making stuff work, so there's different alternatives. Give them your contact info too.
Sure, man. I think I can share a screen here.
Oh, I guess we had it up, but
Yep.
yeah.
Oh, there you go.
Yeah, here it is. So you
Nice.
guys can see name and number, email. I mean, Adam is not hard to get a hold of. So other than that, we appreciate everyone getting together here in the last hours of Friday. Adam, of course, always appreciate your time. We know you're super busy. Michael, thanks again for joining us. And
no problem.
other than that, hopefully we get over this pandemic situation. We get back to meeting like regular, because I know that's important. I mean, these Zoom meetings are nice, but we know we make better connections when we're kind of face to face.
Thanks, John. Thanks, Michael.
Thanks, guys.
Thanks, Adam.
I appreciate
Thanks,
it. Thanks, everyone.